Welcome back to BitcoinDorks. Today, we're diving into the recent price action of Bitcoin, which saw a significant dip of over 5% following the Easter weekend. Let's delve into what drove this price movement and what it means for the broader cryptocurrency market. Bitcoin, the world's leading cryptocurrency, experienced a notable downturn in its price over the past few days, catching many investors and traders off guard. The cryptocurrency, which had been trading relatively sideways in recent weeks, saw a sudden drop in value following the Easter weekend festivities. So, what caused this sudden dip in Bitcoin's price? Well, like many other financial markets, cryptocurrency markets are susceptible to fluctuations in trading volume and investor sentiment, especially during holiday periods when trading activity tends to be lower. In the case of Bitcoin's recent price dip, some analysts point to profit-taking by short-term traders looking to capitalize on the cryptocurrency's recent gains. Bitcoin had been on a bullish trajectory leading up to the Easter weekend, reaching new all-time highs and garnering significant attention from retail and institutional investors alike. From a technical perspective, Bitcoin's price chart had been showing signs of overbought conditions, with key indicators suggesting that the cryptocurrency was due for a correction. The sudden drop in price following the Easter weekend may have been a natural response to these technical signals as traders took profits and adjusted their positions accordingly. Cryptocurrency markets are renowned for their volatility, characterized by rapid and sometimes unpredictable price swings. This volatility is a defining feature of the crypto landscape and is driven by various factors, including market sentiment, regulatory developments, technological advancements, and macroeconomic trends. During periods of heightened uncertainty or shifts in market sentiment, such as the recent Easter weekend dip in Bitcoin's price, cryptocurrency markets often experience increased volatility. Investors may react to news events, rumors, or technical indicators, leading to sharp fluctuations in prices within short time frames. While such price movements can be unsettling for some investors, it's essential to recognize that volatility is an inherent characteristic of the crypto market and can present both risks and opportunities for savvy traders. Experienced investors understand that volatility is not merely a source of uncertainty but also a catalyst for potential profit. For seasoned traders, volatility offers a fertile ground for implementing various trading strategies designed to capitalize on market fluctuations. Day traders, for example, thrive in volatile markets by executing quick trades to capture short-term price movements. Swing traders, on the other hand, take advantage of medium-term price trends, entering and exiting positions based on technical analysis and market momentum. Dollar cost averaging is a time-tested investment strategy that allows investors to spread their investments over time, reducing the impact of short-term market volatility on their overall investment performance. Instead of trying to time the market and predict short-term price movements, investors focus on accumulating assets gradually, regardless of whether prices are rising or falling. Here's how dollar cost averaging works in practice. Let's say an investor decides to invest $1,000 in Bitcoin using the DCA strategy. Instead of investing the entire $1,000 at once, the investor allocates a fixed amount, say $100, to purchase Bitcoin at regular intervals, such as weekly or monthly, over a specified period. One of the primary benefits of dollar cost averaging, DCA, is its remarkable ability to mitigate the impact of short-term market volatility on investment returns. This disciplined investment strategy works by spreading out purchases over time, effectively smoothing out the peaks and valleys of price fluctuations. By systematically investing fixed amounts of capital at regular intervals, investors reduce their exposure to the risk of making poor timing decisions. Instead of allocating a lump sum of capital at a single point in time, which exposes investors to the risk of buying at the peak of a price rally or selling at the bottom of a market downturn, DCA enables investors to average out their cost of acquisition over the entire investment period. Comparatively, investors who attempt to time the market by making lump sum investments face the daunting challenge of predicting short-term price movements accurately. While some investors may succeed in timing the market occasionally, the reality is that consistently timing the market correctly is incredibly difficult, if not impossible. Attempting to do so exposes investors to significant risks and uncertainties which can have adverse consequences on their investment portfolios. Similarly, during periods of market downturns or corrections, investors may succumb to fear and panic, leading them to sell off their assets in a desperate attempt to cut their losses and preserve capital. While selling during a downturn may provide temporary relief and a sense of security, it also locks in losses and prevents investors from benefiting from potential future price rebounds. In essence, fear-driven selling perpetuates a cycle of buying high and selling low, which undermines long-term investment objectives and erodes wealth over time. From a long-term perspective, Attempting to time the market is a risky and speculative endeavor that often leads to suboptimal investment outcomes. Instead of trying to predict short-term price movements, investors are better served by adopting a disciplined and patient approach to investing, focusing on long-term fundamentals, and adhering to sound investment principles. In conclusion, while the allure of timing the market may be tempting, the reality is that it's a high-risk strategy fraught with uncertainties and pitfalls. By succumbing to fear and greed, investors risk making impulsive decisions that undermine their long-term investment objectives and erode wealth over time. Instead, investors are encouraged to embrace a disciplined and patient approach to investing, focusing on fundamentals, diversification, and time-tested investment strategies to achieve their financial goals. That's all for today, and thank you for tuning in to Bitcoin Dorks. Be sure to subscribe for more cryptocurrency updates and market insights.